So good morning, everyone. If you hadn't met me, my name is Valerie Huntley. I am the Senior Director of Marketing and Events for New Orleans Business Alliance. And I will be joining you today to kick off this session 2 of the Mastercard Digital Doors Small Business Series, in which we will be discussing Accounting 101. So we're excited that you were able to join us today, and I would like to introduce, just jump in right away and introduce our speaker for today, his name is Kyle Henry. He's the Vice President of Marketing Operations for Lendio. Just to give you a brief description of Lendio, Lendio is the nation's leading small business financial solutions provider. With its diverse network of lenders, Lendio enables small business owners to apply for multiple business financing options with a single application. The company has facilitated more than 330,000 small business loans for more than $13 billion in total funding, including $9.8 billion in PPP loan approvals as part of government COVID-19 relief. So without further ado, I'd like to go ahead and introduce Kyle, and Kyle, take it away.
Excellent. Thanks, Valerie. I appreciate the introduction. That was a long way of saying at Lendio, we are very much value small businesses and helping small businesses attain their dreams. And I'm grateful for the opportunity to meet with you all today and talk about one of the topics that I get to talk about quite a bit. And that is accounting and small business bookkeeping. This is an interactive session, so I would encourage you all to interact, ask questions as we go through here. I'm actually going to ask you questions. We're going to play a game or two just so that we make sure that we understand. But hopefully this will be educational and we can tailor it to some of the questions and comments that you may have. So before we get started, I would love to hear from you real quickly about what types of businesses you currently operate and how long you've been in business. You can either unmute yourself and speak. If you don't want to do that, you're welcome to throw it in the chat either way. But I'd like to learn a little bit about you. Someone be brave and be the first one.
Hey everybody, can y'all see me? Can you hear me?
We can hear you.
Hey, this is Zuri Nelson, owner of Botanicals NOLA here in New Orleans, over here in the Bywater area on St. Claude. It's a smoothie and a juice bar, pretty much like a vegan cafe.
And
yeah.
How long have you been in business?
January will be 2 years. New Year's Day will be 2 years.
Excellent. Congratulations. That's awesome.
Thank you. Appreciate you.
Hello. Can you hear me?
We can. Is this Keisha?
Yes. Hi, my name is Keisha Henry. I have Keisha Dolphine, the cooking therapist. I've been in business for 6 years. I'm a catering company, but I also do food management. So I supply food to a hospital at this time. Mm-hmm. Also, so I do contract food management for businesses, hospitals, that kind of thing, on top of the catering.
Excellent. That'll keep you busy. So thank you, Keisha. I appreciate that. And I do have to clarify one thing, just because I like Keisha's last name, Henry. My last name is actually Henry too. It's just IE as opposed to Y, which, just an interesting fact, and you probably don't care about it, but I'm going to share it with you anyways, is that when my ancestors came from the Eastern United States to the Western United States, they changed their last name from Y to IE. So Keisha, we're happy to have you here. Let's see who else we have. Kim, it looks like, is a plant-based body skincare since 2020. Started to do plant-based snacks. Excellent. Anybody else that would like to share? Oh, Lakeisha Smith, it looks like. Good morning. Hudat Barbershop, 13 years. Nice. Very nice. Anyone else would like to share about their business?
This is Aaron Jordan. I'm kind of on the road, but we own Universal Printing, a printing company. Been in business for 11 years. My wife and I own the business. And we also have another business called Main Street Studio. So been in business on that one for 3 years. So those are 2 businesses.
Excellent, thank you. Looks like Brandon, Invincible Handy, just starting out about a month. And Cameron Griffin, it looks like it is a real estate broker and consultant. Excellent. Well, first of all, you should all congratulate yourself as small business owners. That is no small feat, as you probably come to realize. I am going to apologize. I'm getting over just a little bit of cold. I'll try not to cough too much and mute myself when I do. But if I do apologize for that. But congratulate yourself. It is no small feat getting in and jumping in with both feet into a small business. And one of the most exciting things, as you all have probably noticed, is that when you got into your small business, you had the opportunity of doing your own accounting or bookkeeping. Can everybody see my slides okay?
Yeah.
Excellent. Excellent. So I am going to hopefully walk you through today and give you some tips and tricks on things that can help you from a bookkeeping perspective, that can help you empower your business. And that's really my goal for today. So if you have questions or if you have comments that come up, please let's talk through them. Love to have that dialogue as we continue to go through the presentation itself today. So, and if I start going and don't see your chat or something like that, please speak up so that we can walk through this. As Valerie explained, I'm the Vice President of Marketing Operations. I've been involved with financial technologies and bookkeeping and capital investments for more than 20 years. One of my passions, though, is small businesses, specifically around helping small businesses. So I want to kind of get into, and I'd love to hear your feelings in regards to this, but I'd love to hear how you feel about bookkeeping. And when I say that is, often when I talk to people about bookkeeping, it's not their favorite topic. So is that true for all of you as well? Or is there some people out there that really love bookkeeping?
I don't love bookkeeping.
Excellent.
I don't even want to have nothing to do with it, actually. I wish I could get somebody else to just do it all day long.
Excellent. So it looks like, and then we have Kim that says she's good at keeping receipts. It's more of a pain. Let me tell you, this is a natural thing. And let me show you how I felt and feel about bookkeeping, especially for small businesses. So let me show you a quick video. Hopefully you can hear the audio on this. Okay, so how many of you have that type of experience where you've got these big old piles of receipts, you finally get them all organized and something always happens. Either receipts get lost, they get pushed up. I love this example because she does this great job of just piling that up, and then the next thing you know, it's all over the floor. But it is hard, right? Bookkeeping is not easy. And so what I'm hoping to do today is to provide you with some tools and understanding of general accounting and bookkeeping practices that will hopefully help it make it a little bit easier and give you some resources that will help you out. So with that said, let's jump into it. So first of all, why does bookkeeping even matter? I mean, why do we even need to do bookkeeping? Now, there's the standard answer of, well, you got to know how much money you have and how much money is in your business. Very true. So it's like balancing your checkbook, right? At home, making sure you have enough money to pay your bills, trying to make sure that you can afford groceries, keep the lights on, all those types of things. But there's a little bit more to it. especially from a business standpoint. One of the things is it allows you to track goals. I'm hoping that you all have set goals for you financially for your business, something that you're shooting for, whether it's financial independence, whether it's growth, something that you're stretching to work towards. Because as you do that, we can help you put your finances to work so that they actually work for you and not against you, even though it feels like that sometimes. It helps you prepare for taxes. I don't want to talk too much about taxes. That's not my favorite topic, and I'm sure it's not yours either. Taxes are never fun, but obviously it's something that with good bookkeeping, it helps you prepare for those things. One of the other things it does is it allows you to forecast for future needs of your business, whether it's capital, whether it's a loan, and again, some type of infusion, whether it's an investment that comes in and gives you capital as an investor in your organization. There is a bunch of things that it can help you prepare. We'll talk more about that. It also helps you stay organized. And one of the things that I think it does more than anything is it helps you to identify issues or potential mistakes that you may have within your business. And again, we'll talk more about that. And then I put on this slide an interesting term, peace of mind. When you all go home at night, do you sleep well? Do you just turn off your brain and go, everything is great in my business, no worries, I'm just going to get a great night's sleep? Is that typically how it works for you? Yes, who said that? I'm impressed. Typically, that is not the case. Typically, as a small business owner, you tend to go home and think about 100 things that you need to get ready for the next day. Somebody said rarely, thank you. That seems to be a more common answer, is because there's so much on your mind and so much going on that it's hard often to have peace of mind. And one of the things I want to do today is to hopefully give you some tools that will help you actually obtain that peace of mind. So before we get started, one of the things that I'd like to do is to get into this foundationally and talk about some key terms you may or may not know in regards to accounting. And I want to talk about these and make sure that you fundamentally understand what they are. And then after we talk about these terms, we're going to talk about 3 reports that you should become very familiar with as a small business owner that will help you grow. And I just want to make sure you understand those, because foundationally, as we talk today, if you don't understand these concepts, the ideas and suggestions that I'll be giving you won't necessarily make sense. So if you do have questions as we go through this, please let me know. So let's walk through some of this jargon that you've often heard. One is income. Income basically is, what is the money that you receive in return for providing a good or service, right? So it's the money you get from your customers on behalf of that service or product that you provide. Now, income is different than revenue. Revenue is the total income generated from your business. So for example, if you have a bank account that's interest bearing and you get interest paid to you, that is revenue. Then if you add in your income, which we just talked about, that's your total revenue for your business. So those are 2 different things. Income comes from the product or service you provide. Revenue could come from multiple services, and it's the overall influx or inflow of cash or money into your small business. The next one is an expense. An expense is basically the cost for items needed to run your business. That can be anything from, I got to buy a computer, I've got to buy supplies, right? I've got to lease my office, I need pencils, paper, whatever it takes to make your business run. That's what an expense is. And then there's the cost of goods sold, which is often referred to as a COG. And you'll hear that quite a bit, especially if you have an accountant. But this is the direct cost involved in producing your goods, so a raw material. So for example, let's say that we have a business and we're going to create widgets. And this widget, to create it, requires, let's say, wood and paint, just to make it easy. Well, wood and paint would be our COGS, but if I went out and bought a computer, right, to actually do my bookkeeping, that's not necessarily a COG, it's an expense for the business, but it's not a direct cost to produce your goods or service. So I want to stop there with those 4 and make sure there aren't any questions, comments that we could answer about those 4 things. Does that make sense? Don't be shy. I'm going to ask you a lot of questions. Yes, yes. Bunch of yeses. Excellent. Does there anybody have any concerns? Maybe I should ask it that way. Okay, then let's go ahead and keep going through the other ones. So gross profit is the next one. That's the income earned minus the amount you spend to produce your goods. So it's basically taking that overall revenue that we just defined a minute ago, minusing out your COGS, or the cost to produce your goods and service, and that's what your gross profit is. The next one is net profit. This is the actual profit you make after deducting all of your gross profits and expenses. So basically what happens is once you've paid all your bills, this is how much money you have left over. That's the simplest way of putting it. And so this is an important number, right? Because this is, at the end of the day, how much money do you have to invest in new things? Is it new products, marketing, sales? Is it to be able to buy additional inventory so that you can produce your goods or service? This is a very important number that we'll really get into. The next one is an asset. This is basically something that your business owns. So again, if your business owns a computer, that is considered an asset of that business. If it purchased a vehicle, same thing as an asset. If you bought furniture, all those types of things, anything you purchased on behalf of your business that your business owns is considered an asset. The next one is liability. So liability is when your business owes money or owes something. So for example, if you take out a loan for your business, that's a liability for your business that you have to actually pay back. And that one obviously is you want to keep your liabilities as low as possible by keeping your net profit as high as possible. And again, we'll get into that a little bit more. And the last one is equity. So what equity is, basically, it's your business assets minus your liabilities. So you basically add up the total value of everything that your business owns minus anything that it owes, and those are your equity, or what type of cash opportunity you have in your business that you can reinvest or invest to grow your business. So these are kind of the key terms that we'll be talking about today. Any questions about any of those? Concerns? If I start going too fast or too slow, feel free to let me know. All right, no concerns. So let's go ahead and jump to the next one. So now that we understand those basic terms, we need to understand how do we identify how those are helping our business. And this is really done with 3 basic reports. One is the balance sheet. How many of you heard of a balance sheet? Just throw yes in the comments or that, or you've used one before. No one? Oh, Kim, thank you for asking that question. I will give you a copy of this presentation. So everything that we have in this presentation, 100% you will get. So absolutely. Thank you for asking that. Perfect. Okay, so a balance sheet, looks like most of you have had an interaction with that, right? Your balance sheet is really just the report of your cash and your other assets, liabilities, and balances, right? So it's kind of your looking at your business for a certain time period to see where you financially are, right? Do you have more liabilities? Do you have more cash that you can reinvest? It kind of gives you that short-term view of how your business is doing. Then after that, you have your profit and loss statement. And this is one you probably, if you're familiar with your cash flow, I'm hoping you know what your profit and loss, or often referred to as the P&L, is. This is the main driver of your business that you'll use for your taxes, you'll use for when you look to get additional capital. Everybody, when they look at the strength of your business, typically look at your P&L report. And what that profit and loss report is, and by the way, it's often referred to as an income statement. So if you hear income statement, that's the same thing as profit and loss. Accounting practices are trying to get away from income statement and just use P&L, but if you do hear that, which you will from time to time, they're the same thing, just so you're aware of that. So this report really shows your revenue and expenses for a given period of time. This tool really allows you to see where your costs or your operating costs are going. So specifically, how much are you paying on rent every month? How much are you paying for materials to produce your goods or service? It provides you with the opportunity to really get a good understanding of where your cash is going within your business. The other thing that it does is it provides you a good view of where you could potentially invest more to make your business more profitable. And again, we'll get into that and show you some examples of that. The last one is a cash flow statement. This is a report that shows the ups and downs of the cash entering and leaving your business. So basically, this shows you over a period of time how much cash is coming in versus how much cash is going out. Can somebody tell me why it would be important to understand your cash flow? Don't be shy. I know you know. So you can budget and forecast. Thank you. Excellent. Right? Because you really need to know where your cash is coming from, and more importantly, at times predict when you're going to get cash, right? So for example, if you have outstanding invoices that somebody owes your business and you know that they're coming due at the end of the month, it's important for you to know that at the end of the month, you're going to have an inflow of cash, which you can then prepare for paying your bills and or reinvesting into your business, right? So perfect. It's an excellent budgeting and forecasting tool, but these are the three main reports as a small business that you should really pay attention. If you have not looked at these three reports directly for your business, I would encourage you to become familiar with them because they are really going to be able to help you drive the success from a financial perspective. All right. So before we move on, any questions about those terms and or those three reports? You learned anything new yet, or is all this repeat information for you so far? So shy. You guys are so shy. New for me. Excellent. Thank you. So what we want to do for the rest of the time period here is now we have these foundational pieces of bookkeeping and accounting. Now let's talk about how we can leverage them to make you a more successful business owner, right? So for example, on today's agenda, I want to talk about 6 things. And you probably see me look off to the side a little bit. That's where my presentation is on this. So I apologize if it's a little distracted, but that's what I'm looking at. First of all, we need to talk about the importance of separating your personal and business expenses. We want to talk about managing your cash flow. Again, how do we make sure we make a good balance between revenue coming in and expenses going out? We need to talk about major expenses, setting financial goals, budgeting, as Mr. Griffin talked about, excuse me, is that it is very important that we make sure we do that. Schedule regular times for bookkeeping. We'll talk about why that's important. Meeting with a tax professional regularly. If you don't have a tax professional, we'll talk about this more, but it will be important for you to have a very good and reliable tax professional. And then the last one is, I want to talk about developing a system that works best for you. Everybody has a way of doing their own accounting. Everybody has a different way of potentially doing bookkeeping, and you just need to find what method works best for you. And we'll talk about several different methods to kind of help you with that. So let's dive into this. So first of all, separating your personal and business purchases. How many, quickly in the chat, use your personal banking account or checking account as your business account? Anyone that does that? Ooh, never, no, no. All the right, not anymore. Kim, thank you for saying that. No, sir. Excellent. First of all, you've learned the very first important rule when starting your own business is you need to separate your personal expenses from your business expenses. There are a lot of small businesses when they start, and Kim, I appreciate you putting on there not anymore. When you start, a lot of businesses go, well, I'm just going to manage it through my personal because that's where the money's coming and going anyways. And the fact that you're a key investor in your own business makes it easy for the money. The problem with that is it's hard to reconcile at times what is a personal expense versus a business expense if you're not putting them together. So it makes it a whole lot easier if you just create a business account, put everything for your business in one account. So it makes it simple and easy to track what's going on. The other thing that it does is it avoids an IRS trigger. And I want to talk just quickly about that. So when you have those two merged together and you start looking at your P&L and also at filing your taxes, there are several things that the IRS looks for that are not business related to see if people are claiming personal expenses through their business. So, excuse me, if you have those two separated, it's very easy to avoid that. If you have them together, sometimes they get mashed up and it's very confusing and often can lead to a trigger of an audit from the IRS. The other thing that it does is it also limits your personal liability. And what I'm referring to as this is if you accidentally claim a personal expense as a business expense and then you get audited, there's a fairly large liability that comes from that. And what that liability is if the IRS audits your business expenses and they're mingled with your personal expenses, guess what? They're now going to audit your personal expenses as well. So you kind of get the double whammy. But if you have them separate, it's a separate liability, which means they have no right to go into your personal expenses unless there's a direct need to do that. And you really want to avoid an IRS audit. Has anybody, just out of curiosity, gone through an IRS audit for your business? I hope not. If you have, I'm sorry, those are not easy and they are not fun by any stretch of the imagination. So this is one of the first rules I tell small businesses: make sure you keep your house in order so that you avoid having to talk to anybody in the IRS. So it looks like a majority of you are doing that. I did put on here a straight face test. I get asked the question from time to time, well, how do I know if it's business versus personal? Well, I say use the straight face test. If you can look an IRS agent in the face and tell them that your trip to Hawaii was for business without smiling or sweating, then maybe you should be able to claim it as your business. If you can't, then you probably shouldn't. So it's kind of that straight face test of, can you really say that with a straight face? Just something to think about as you're doing your purchasing. So let's move to the next one, which is managing cash flow. So this is really when you categorize and track the costs and your revenue and your expenses that are associated with your business. So managing cash flow, it helps you identify growth and strengths and weaknesses of your business, right? So for example, one of the things that I often find is sometimes small businesses have in their mind that, you know what, if I don't record that I got cash, you know, I'm not gonna have to pay taxes on that. Please, please, please do not do that. Make sure you're recording all your cash transactions. I see a lot of audits that occur because somebody else who paid the cash claims the cash, then the business doesn't claim it, and the IRS goes, wait a minute, what happened to that money? Well, guess who they're going to come to find out? They're going to come to you as the business. So please, please, please make sure that you're recording your business, or excuse me, your cash transactions. One of the other things I want to talk about is money owed, specifically around invoicing, right? It's very important to understand how much money you have coming in and when it's going to coming in. So if you have outstanding invoices that are due to you, knowing when those need to be paid or should be paid will help you make a better decision on your purchasing and buying. So I know at the end of the month, I'm going to get $3,000 for these invoices, which means at that point, that may be a good time to pay your rent, pay your utilities, whatever else that you need to be, so that you don't prepay and you keep that money as long as you can, which kind of leads us into the next point, which is delay vendor payments. Now, I want to be very clear in this, as you'll notice the asterisk to the side of it. If you look down at the very bottom, there's super small print that say pay vendor when it's due, not before. Keep your money as long as you can. So when I say delayed vendor payments, I don't mean don't pay them when they're due. What I mean is, if you get an invoice at the beginning of the month that's due at the end of the month, don't pay it as soon as you get that invoice. And the reason that is you should keep your money and let it work for you as long as you can until it's due. So if it's due on the 25th, pay it on the 25th. Don't pay it on the 1st. And that will help in a couple of areas. One is, what if something happens and you need that cash throughout the month due to an emergency or something went down? You've got to be able to have that cash readily available. The other thing is, if you have interest-bearing accounts, you want to get as much interest as you can on those cash accounts before your money leaves your business. So when I note on here, delay vendor payments, again, it's not that you don't pay them, just make sure you pay them on time, not pay them early. Does that make sense? Kim, thank you. I appreciate that. Excellent. The other thing is, by managing your cash flow, you can also help cut your costs, right? Because you can see where your money's going. If you find out you're paying $900 a month on taking people out to lunch, it's probably a good indication of going, maybe I can cut some costs there and not put as much taking people out, and maybe put more into my marketing budget or back into my COGS or the costs associated with producing your business or service. So it allows you, by monitoring that cash flow, is to really understand where the costs of your business are going. And the last one I just want to talk about this is also allows you to forecast your capital needs. If you find that throughout your business cycle, especially on a monthly, quarterly, yearly, however you determine is the best way to manage your business, if you know that at certain times of the year, your cash flow goes down or negative, knowing those types of things will help you forecast when you need capital, when you need people like my business, Lendio, to help you facilitate maybe a line of credit, maybe a loan, maybe to get investment money, something to help your business to meet that next need. And so it's important to, again, watch those things so that you can make sure that you can forecast when you need that money. Because the worst thing would be is waking up going, oh my gosh, it's Wednesday and next Monday I'm going to be out of money. It's a lot easier conversation if you're going, hey, it looks like in December I'm going to be low on money, so I can start planning for that now. So making sure that you're watching those ebb and flows as that revenue goes in and your expenses go out, and where each of those items are being spent will help you considerably as you plan and as you continue to move forward with your business. All right. Any questions about managing your cash flow? Everybody still with me? Excellent. Thank you. So now it's time to play a game. Now you have to participate. So it's time to see how much we've learned and what we know. So we're going to play a game. In this game, we're going to test some of your bookkeeping and accounting skills based on everything we just talked about. Okay. So I need you to interact with me either via chat or unmute yourself, because this game will only be successful as if you participate. So what we're going to do is we're going to practice assigning items to a P&L or profit and loss statement. We're going to assign items to a balance sheet, as well as we're going to categorize revenue and expenses to make sure that we understand how those things function. And for the sake of this game, we are all going to be part of a company called Yorko. I know, clever name, but it's just your company abbreviated, right? And for our benefit, we manufacture widgets, right? And so we have COGS that are associated with basically manufacturing these widgets. So with that context, let's play a little bit of a game. So here is Yorko's balance sheet, right? On the left side, you will see all of the different types of categories on the balance sheet. You got your current assets, a fixed asset, your liabilities, and your equity, which we've talked about several of these. And then on the right side, we have different things or money-based opportunities that we need to be able to identify where they go on our balance sheet. So what we want to do is to take everything that's on the right column and put it on the left column. Does that make sense? So let's practice one. So the first one is cash. If we get cash in the business, where does that go on your balance sheet? Tim says asset, current assets. Okay. That's exactly right. Right? So that's your current asset because you actually have that in hand. Good job. What about equipment? Where would equipment go? Excellent. I see a bunch of fixed assets in that, right? So the difference between a fixed asset and an asset, right, is a fixed asset is something that is tied directly to your business. It's not easily equitable or meaning can turn into cash. Whereas if you have actually a cash asset, right, you can sell it right away, where equipment you can't. Good job. What about a business loan? If you went out and take a business loan, where would that go on your balance sheet? Excellent. As it comes running in, it's a liability, right? Because that's something that's that your business has to pay back. Good job. What about your widgets inventory, right? So we made all of these widgets and they're sitting in inventory. Where would that be on your balance sheet? Oh, did I stump you? Current liabilities or liability? It's actually an asset, right? So why would it be an asset and not a liability? Anybody want to answer that question? No takers? So the reason that it's an asset, right, is because if you sell the widget, it's going to turn into cash in hand. Excellent. Kim, I should have waited just a minute. The three of you answered exactly right. It's because you have something that you can make money from it, right? And you can sell it to actually create an asset or a current asset for your business. That's exactly right. Good job. What about accounts receivable, right? And let me just define that, right? Accounts receivable means money that's owed your business by somebody else. So where would that fall in your balance sheet? Current assets? Good job. 100% right. Good job. What about a line of credit? Perfect. So that is a liability. What about accounts payable? Now, accounts receivable is what money is owed you. So accounts payable is what money you owe someone else. Good. Good. That's definitely a liability. Okay, so let's use one of the terms we defined earlier. What about net income? Remember what net income was? That's your income after you pay all your bills. Right? So that is equity, not an asset. So why is that different? Any ideas? Right? Because remember, an asset is something that came in and paid for something, where equity is after you've paid everything, that's what you have left over. So that means you have equity in your business because you've already paid all your bills. Good job. And both of you defined that, and the last two comments were spot on, right? It's all about your equity. You've already paid your bills, as well as any type of ownership potential that you can pull from it. And so the last one, owner equity, is the same thing, right? That one's kind of a softball because it actually has name equity in it. Good job. Good job. Well done. So now we have our balance sheet. Now we need to do our profit and loss. So here's the same thing that we want to do, like we did on the previous exercise, right? On the left is we have what's coming into the business, what's going out, what are we netting as a part of that process. And then on the right, here are all the different things that will affect our P&L. So let's start with the first one, net income. Is that an in, an out? Okay, everybody's saying it's an in, but it's a net, right? So that's a trick question a little bit. Because remember, net income is after we've already gotten all of our ins, paid all of our outs, right? It's the difference between the two. Okay, what about revenue? Good. Good answers coming in. Definitely an in, right? Because remember, this is what you're getting for your goods or service. And any additional other income you may be getting, like off of a interest-bearing checking account or other investment opportunities. Good job. What about expenses? Okay, outs, very good. So let's be more specific then. What about your rent? If you're renting a car or a where your business is, out, very good. So it's a type of expense, right? So you'll notice that under the out, I have expense, but then I have rent, but it's kind of indented because that's technically, it rolls up into an expense. The question, if you have access to this video or PowerPoint, 100%, we will share this PowerPoint with you and you will have access to everything that's in it. So absolutely. Absolutely. So what about marketing? Good. That's exactly right. It's another expense, right? It's the price of doing your business. Good job. What about your COGS or your cost of goods sold? I see an in, I see a couple of outs. Right? It's an in. Why is it an in? Can somebody tell me why the cost of goods sold is an in? Kim Tran, that's 100% right. You're getting paid for those costs, right? So you have these costs of goods sold that you will be paid for. And so it's considered an in on your P&L. That's why this one is probably more confusion pretty much getting paid in the future. That's right. You got it 100%. So it's basically banking money that you know, as you sell your goods or service, that money will come in for them. That's 100% right. And I know that one is confusing. I saw the other Kim make that comment, and that's typically why it's confusing. The best way to look at it is you're basically banking money into expenses that you paid to produce your goods or service. So it's just a matter of time of getting that money back once you actually sell your goods or service. So on your P&L, it's considered an in because it's something that's going to happen, or you'll realize that income in the future. Good job. And the last one, what about your widgets inventory? I see one in. Anyone else have an opinion on that one? In. Very good. Same thing, right? It's just a different line item under what revenue. Excellent. Super smart. You guys are on it. So before we move on to the next one, questions about the P&L or where these things reside on your P&L? Are we good to move on? All right, let's do it then. All right, so now the fun really begins. We're going to play what I call the penny game. We're actually going to take money and put it in our balance sheet and where it goes on our P&L. Now we're going to put those two last games together and then hopefully not confuse you through this process. But I want to make sure we're foundationally building you up, saying we've got the definitions, we understand how each operates. Now, how do they work together to make my business more effective? And that's why I like to do the penny game. So based off of the questions that I ask, I would like you to tell me where the pennies go. Should they go on the profit and loss? Should they go on the balance sheet? Or do they go on both? And if so, where? So that's a pretty big and loaded question. So I'm going to give you an easy one to start with. So you start your business by investing 3 pennies of your own money. Where does that go? Okay, I see a P&L, but where on the P&L if it goes somewhere? Okay, current assets I see. Be specific, where in current assets? Excellent. So that would be cash under your current assets on your balance sheet. Right? It's not quite on your P&L yet, and we'll talk about why that is in a minute. So right now on your balance sheet, you have cash that came in that you invested, right? So that is a current asset and it's a cash asset. But it's not in your P&L quite yet because remember, an in is revenue based on what you get from your customer, not from what you invest in your business. That's the difference. That's why it's not on our P&L yet. Okay, so let's try the next one. You pay cash for 3 pennies of inventory. So what happens now? P&L in? Not quite. Anyone else want to venture? Current liabilities? Out? We have a few outside the board. Let's see what the answer is on this one. So, 2 things happened, and I apologize. I forgot to show on the previous one where the cash came in. You'll notice at the bottom on the left side, the equity, that owner's equity got 3 pennies when cash came in. Because remember, the owner, you as the owner, is the one that invested in that. So you had a cash asset, but you also had equity because you put 3 pennies in. I apologize that I forgot to mention that. Now on this one, where it says you pay cash for 3 pennies inventory, all that does on your balance sheet is it moves it from a cash asset to a inventory asset, right? Does that make sense? So all it is a reclassification of where that current asset is being held. Now, why is it important to know that your current assets is in your inventory versus your cash? Why can't we just say, oh, we have 3 pennies in current assets? Any ideas? Kim Tran, excellent. That's exactly right. Right? Is cash is flexible, meaning I can spend it today for anything, where inventory, I've got to sell it before I can actually have the cash to make that. So by knowing that you have 3 pennies in widget inventory, but none in cash, means you need to do what? Sell some inventory, right? So that you can move that. Exactly. That's exactly right. You got to make a sell. That's why these different categories, it's very important not just say, oh, it's a current asset. Well, what kind of asset is it? Because that will determine what you can and can't do for your business. So right now, based off of those 2 things, right? 3 pennies investment that you put in, and you put 3 pennies in widget inventory, you still have 3 pennies of owner's equity, because remember you put that in as the owner, and then you have your 3 pennies in your widgets inventory. So let's go to the next scenario. You borrow 2 pennies from your family. Where will that go? Okay, be more specific. What type of liability? Business loan. Perfect. Right? So now you have 2 pennies, but notice where else you had 2 pennies that just got added. Did everybody notice that? You got 2 pennies added to your business loan, but you also got 2 pennies in your cash assets. Now, why would that be? Excellent. Because you borrowed money, right? So you have a liability, but you still have cash from that liability to spend. Excellent. That is the exact right comment, because you have to track that you still owe that, but you also have that new found cash that you can now spend for your company, right? So now we have 2 pennies in cash, 3 in our widgets inventory, 2 in your business loan, and 3 in your owner's equity. Okay, let's hold on. Zuri Nelson, you said I'm confused. What are you confused about? What can we answer to help uncalm your confusion? Are you confused about the business loan and the cash, or did we miss something else that's confusing you at this point? Right, so let me recap it then, just to hopefully clarify this just a little bit. Whenever you take a loan out, it means they gave you money, right? Oh, gotcha. Yeah, I mean, these concepts are a little difficult. That's the reason I like doing the penny game, because it breaks it down. And again, you'll have access to this afterwards that you can re-go through it, that will help you understand where that happens. But most of the time I see the confusion here is because you think about, you got your loan as a liability, but you don't think about that the residual of that activity. So you got a loan, yes, but that loan meant cash. So you have both. You have a liability you still have to repay, but you also have 2 pennies in cash, which essentially, right, zero each other out. Right, so let's go on to the next one, and it may help clarify this just a little bit. So you sell 1 penny of inventory for 1 penny cash. So what happens in this case? Okay, so basically you pulled one widget out, sold it to somebody for 1 penny. So what happens? More equity, less ownership? Not quite. Okay, so close. Those are good suggestions. So watch the screen very closely. What happens? Right, so first of all, over on your P&L, you have 1 penny of revenue, right? Because now you were paid by a customer. And as a subcategory of that revenue, it came from your widgets inventory. Does that make sense? Which means on your balance sheet, you now have 3 pennies in cash, and your inventory went from 3 to 2. Could it go in both, Kim? Tran, help me understand when you say both. Yes, 100%, you got it. It goes both on your balance sheet and your P&L. So let's review what just happened. Right, so I'm going to go back because this one's a little trickier. Right, so if you sell 1 penny, look at the right side. You sold it, which is revenue, right? We talked about that earlier. Now, as a subcategory of revenue, it's widgets inventory revenue. Right, so now we know where the revenue came from. Remember, we talked about how important that is. So first, that's your P&L because it's actually an interaction with your customer. But now watch the balance sheet on the left side. You got a penny, right? Because they paid you a penny, so your cash went to 3. But your widget inventory went from 2 to 1 because you sold it. So you got revenue on your P&L, and you got cash on your balance sheet, and your inventory went down. Does that make sense? This is for those of you that are kind of walking through this going, oh man, this is a little more complicated. Now you know why we do the penny game. It's very easy to get lost through this, and that's why I like doing this situation. So let's do another one. This time you sell 1 penny of inventory for 2 pennies. So instead of just 1 penny of inventory for 1 penny, now it's 1 penny for 2. So what's the difference in this scenario? It's just the amount of cash you got, right? So let's watch the right side. Right, so now the right side, you see now we have 3 pennies of revenue because we've sold 3 pennies. We have we have inventory that went down. And we have more cash. So it's the same scenario as the one before. The only difference is you made twice the money because you sold it for twice the amount. Does that make sense? Okay, so I know we're a little tight on time, but I want to do one more. You sell 1 penny of inventory for 2 pennies, and you sell it on credit. So now what happens? Same situation, right? So watch the right side of the screen. 2 more pennies of revenue, 2 more pennies for widgets inventory. But the difference is on your balance sheet, you lose your widgets inventory, but instead of going in cash, it goes into accounts receivable. And remember what accounts receivable is? That's money that's owed you because you extended credit. It's confusing because of widgets or pennies. That's fair. right? So what happens in this scenario is it's just like the other two. The only difference is instead of the current assets being based off of just cash, now it's on your accounts receivable because they still owe you that money, but on your balance sheet, it shows that you have that money. Does that make sense? Or did that one really throw you for a loop? All right, we're going to go ahead and move on. This is a good game for you to do if you ever want to just sit down with pennies and kind of move these around. And if you have questions, and if you do have an accountant or a CPA you work with, this is a good exercise for you to have them do with you so that you can actually see how you're realizing your money. Because understanding all of these different things like we talked about lets you understand where the strength of your business is. So for example, if you look at this sheet right now, it tells us a few things, right? One, you have cash to spend. Two, you don't have any inventory, which means you can't make any money. So we better use some of that cash to make some more widgets. Does that make sense? And if we have enough cash, maybe we'll pay a penny off our business loan so we don't owe as much money. Okay, so we have about 5 minutes left. So I want to go through just the last couple of slides and then leave a little time for questions. One is I'm hoping that exercise let you see how using the balance sheet and the P&L together really does allow you to start leverage and making really good decisions for your business. Keeping your cash flow strong and making sure that we can make those decisions when they need to be made. One of the other things that was brought up earlier by one of you was, well, what about budgeting and setting goals? It is very important that you are doing both. So for example, if you set a budget knowing that at the end of the month, that it's going to cost you, and I'm going to use our penny game example, 3 pennies for your rent, and you have 5 pennies in cash, but you need inventory, you're not going to want to spend 5 pennies to make inventory because you won't have enough money to pay your rent at the end of the month. Right? So you need to keep 3 of those 5 pennies that you have in cash so you can pay your rent. So by budgeting, it allows you to see the upcoming expenses you have. So as you're looking at your cash flow and you're looking at your P&L, you know when and what kind of smart decisions that you can make. Right? So number one, as you look at this slide, better purchasing decisions helps you avoid that overspending. Uh-oh, did I pay too much on? We talked a little bit about this, right? Taking people out to dinners versus creating widgets. It allows you again to forecast, am I going to need money? Am I going to run out of money? At some point, your business is going to need capital, whether it comes from you, comes from a member of your family, comes from a line of credit, or comes from a loan. You're going to need capital to grow your business. So being able to forecast when you need that is critical so that you don't get it too soon and you don't get it too late, right? I use the example of, I worked with a small business once that was a pizza. They were just opening their second pizza dealer. And basically what happened, within 3 days, they had a fire and their pizza oven blew up. Right? Well, they needed cash right away. So they came to a company like Lendio and said, hey, I need cash. We were able to get them cash within 24 hours and they were up and running again. Now, that wasn't something they could forecast, but let's say that they have an old pizza oven that they know is going to break down in the next year or two. Well, then we need a budget for that and start putting money away so that when that happens, we're ready to handle the situation, right? The next one is tax preparation. Make sure that you're preparing for payroll tax. That one is hard. And if you don't understand payroll tax, please talk to a tax advisor or a CPA, especially depending on your state. I don't know your state specifically's rules, but I know I'm in Salt Lake City, Utah area, and ours are not uncomplicated. So please make sure you're getting the right guidance. The other one on this is set financial goals. Make sure that you're setting goals for yourself so that you're reaching towards something. Because if you're not working towards anything, then you don't know where to put your money. right? Last but not least, make sure you're setting regular times to do your bookkeeping. Don't get behind. I find too often that small businesses wait and they wait for like 4 months and then do it. And that's when they forget, oh, did I do this? Does this mean that? Don't do that. Get into a regular rhythm, whether it's I'll do it the first day of every month, whether it's I'll do it every time my credit card or my bank statement comes, something that comes in that keeps you on a regular cadence of doing that. Because if you do that, you'll avoid those mistakes, and it takes a lot less time if you're doing them in small chunks instead of all at once. The last thing that I would just talk about is, we talked a little bit about this one, was around tax professionals. Make sure you have a tax professional so that you make sure that you're doing things based off of best practices, getting the largest tax deductions that you have. Make sure that you have help. And again, I threw in that peace of mind again. Knowing that you're doing everything you can does help you sleep a little better at night. Sometimes it doesn't feel that way, but it does help. And then the last one is develop a system that works for you. Some people don't like to use online systems. People like to use spreadsheets. I have a lawyer friend that to this day has a shoebox from 1988 Nikes that he bought, that he puts in his receipts every time he gets a receipt. And as soon as that shoebox is full, that's when he does his bookkeeping. I wouldn't advise that, but it works for him. So make sure, as you get a lot of advice in that, some things work for some people that don't work for others. Make sure that it works for you. Now, we at Lendio, we do offer a bookkeeping service for our small businesses that I'll talk about in a minute. But one of the things I just want to end with is successful bookkeeping will directly impact your business growth. We talked about different ways leveraging what you see on your P&L and your balance sheet. Make sure that you're staying up on those, and you can really make your business better by doing so. I love this quote: failure is not falling down, but refusing to get up. As a small business, you get tripped from time to time, and it's hard. Just keep getting back up, because what you do is so valuable to us as a society, to you as a community, and to yourself, that though it's hard, please keep doing what you're doing. We appreciate it. Hopefully today has given you some exposure of that. Just as a participation bonus, and we'll share this with you, is that, like I said, Lendio has a bookkeeping service that they provide. If you want to check it out, we'll give it to you free through the end of the year, just to see if it works for you. So we'll give you a link that if you just click on it, that you're able to check it out for no cost to you. If that's something you want to explore, if you already have a bookkeeping service or like the way you're doing it, perfectly fine. Just want to give you that option as well. So here's to your success. What, if any, are there questions that maybe I can answer for you in the last few minutes based on what we've talked about today? Hopefully you've learned something new or given yourself something to think about. No questions? You're all experts now, right? Kim, thank you. Thank you all for participating. I do have on here my LinkedIn profile. If you want to reach out to me, if something comes up or you have questions, you are more than welcome to reach out to me. Well, I will definitely get to Valerie a copy of the deck. You can play the penny game on your own, test your knowledge and kind of go through, as well as I'll get you out that link if you want to try out the bookkeeping just to kind of help you. And again, if not, that's fine. It's purely optional. We just wanted to give you a resource as we go through this. And you also have my LinkedIn contact information. If something comes up, please, I'll be happy to answer any questions. Just understand that I can't answer tax-related questions because I don't know your state tax laws, but I can answer general accounting and bookkeeping questions for sure. So thank you all for your participation. It was great meeting you, being able to understand a little bit about what type of businesses that you have. I wish you nothing but the best of luck. I love this series that you're going through. Continue to do what you're doing and being a strong contributor to your communities. Thank you so much and have a good rest of your day.
Thank you so much, Kyle and Lindio, for this great presentation. I wish that I could pay my vendors late or right on time and keep my cash flow, but great tips. And as you've seen in the chat, a lot of positive feedback, and we will be providing, as Valerie stated, your information post this presentation. So thank you so much.
Thank you. I appreciate that.
Next week's series, for those that are in attendance, we'll be sending out a link. It's for the SBA and its emergency preparedness, featuring Ms. Benita Rice of the SBA and the LA Department of Insurance, Mr. Ron Henderson. And it's going to focus on assessing your business specific risks, creating a continuity of operations plan, insurance considerations, going back to finance, events, the finances available for a disaster, and how to do that in succession planning. Thank you. We look forward to seeing everyone, and thank you all for coming. We'll see you all next week. Thank you, Kyle.
Thank you, everybody. Have a great rest of your day.